Hello, welcome. Today's talk is about how to hedge against black swans. Now, you guys know what the black swans is, right? It's the unknowns of the unknowns in the future. So you're trying to hedge against something that you have no idea what it is. And of course, if you don't have any idea what it is, you wouldn't have any idea when it will happen. But the person who came up with this black swans thing, Talib, the guy with the mustache, he gave us two type of solutions. And the first one is called hyper conservative and hyper aggressive approach, which is one. The second one is speculative insured portfolio. Quick explanation. The first one simple. You just buy 85% of your money, put everything into T-bills. T-bills belongs to the government. So unless you foresee that the government is going to disappear, then all your money will be gone. And then the rest you will put it into angel investments like speculative type of things like Bitcoin and so on. So hopefully, if anything happens, right? If anything happens, you make a lot of money here to compensate for your T bills. Actually, T bills price have actually gone up because interest rates have gone down. But generally, what we're thinking is that people tries to make get the interest from the T bills, which is pretty low. All right, so that's how he does it. The second way that he does it is called for speculative insured portfolio. In this, in this, what he suggested is that um, buy everything into speculative investments, like Google or whatever. Long time ago, if you bought this, and then you try to insure for losses greater than 15%. Now, how do you do that? Just hold on, I'll show you again. Hello. This is a screenshot of my system, and the stock you're seeing here is SEA, short form SE, which is a Singapore-based company that does a lot of video games and stuff like that. Right? It closed at 173.47. I'm using um, n- the data is not live now because it's still early in the morning. So the market haven't started yet. I'm just giving you just to show you how the thing works. So assuming you bought at 173, that means your 15% downwards maximum limit is at 140, between 145 and 140. Okay, so you have to buy an option for 100 shares at 1.19. That's what it means. Obviously, I'm looking at 28 days, right? 28 days. So within these 28 days, your share in SE will go up and it can go come down. That's just the way life is. If it keep on going up, um, you may need to adjust this, because if it goes up 20%, and you will not be, your stop loss at 15% will not be at 135. Obviously, the other thing he was saying is that you can use a stop loss as well. Instead of insurance, you can use a stop loss. Um, most people would use a stop loss maybe at even 10%. If you lost 10% of your shares, but like I say, market today move pretty fast and pretty wild. Even in one day, it can move up by 10% if you're not careful. Stocks like this is a speculative growth stock. It doesn't. I don't think it makes any money still, but it's a growth stock. So people are just buying it purely because it's a growth stock. So you got to be careful when you're doing speculative stocks. These are, I mean, like long-term investments are like companies like Apple, Google, the FANG stocks, and so on. Or you can even buy an index, index like SPY or whatever. But what he's suggesting to you is that if you ever go into speculative stocks, you should have at least 15% insured, insured down to 15% of the value down, or you can put stop losses if that's what you want, whichever way. Sorry for pausing all the time. That's because I have a bad cough and I was coughing. Anyway, so what's the problem? I mean, what's the problem with this kind of scenario? This scenario, there's no problem except there are, you can't see it now, but The volumes may not be big, and then if you have, I mean, look, nobody just have 100 shares, right? One option carries 100 shares. So when you have big players coming in, the prices will change quite dramatically. So for example, let's say Baba. Baba is quite a big stock. It's $264, and it's supposed to be quite liquid. So, but sometimes you see there's a tendency. For example, the market is looking at downward pressure. So the difference between the bid and spread is different. So let's look at the 30 days again. It's about 11:15. Okay, so it's still pretty good. So if you, I mean, the further away you're from the 264, so let's say another 15% is about 26 minus 20, about 30. So it's about 230, 235, 225. So it's about $1.82 or $1.90. so you so you would constantly need to buy insurance. Maybe you can buy half in insurance and half in stop losses. Because the reason why stop losses may not put it through when the market is going down, because it can just drop just like that, just like that. But even if it drops just like that, you whatever price you have at the time, it will just sell it. You can't do anything. But options are better, because options you're guaranteed that the other side will have to buy from you at whatever price you want to sell. That is 230 or 235. So it's a much better option. But the problem with options is that it has an exchange, but the exchange is limited. The players in the exchange are big players. So they will know big players. They control, in a way they can control the market. If you try to buy more than 100 call or put options, the price will change dramatically. You can't see it here, but this is one of the issue that you have. And sometimes the maturity dates may not be the one that you want. Um, Even though people may not complain about the maturity dates, it goes up to up to 2 years, I think. So it goes up to year 22. So it goes up to 2 years at a time. So, for example, if you have a portfolio and then you want to hedge it for, I mean, normally you will not hedge it for 2 years because your portfolio changes, right? For example, today is 263.64. It can go up to tomorrow 270. So it means that you probably have to adjust your option price. So what you do is that you have to sell off the option that you bought, and then move it up to to where it is, just to trial the upward forces. You don't have to do it all the time. I mean, you don't have to do it all the time. You can do it whenever it goes beyond the 15%. Right? So, for example, you already hedged it at 15%. Your price went up so fast to, upwards. So your 15% now is outside. So probably become 20% or 25% from the highest point. So the question is that, do you want to re-hedge the problem again? But this is up to you. The reason is because you actually bought the share at 263 or $263.88. So as far as you're concerned, you can still keep it, but normally people would adjust that. So you have at least once a month to make sure that your thing doesn't fall apart if the Black Swan event comes into play. Actually, sorry, it goes up to January 2023. So it's not 22 but 23. But you will notice that as the time goes further out, the position is limited. So there's no February, like March, April position. It's just January, June, and January again at 23. So you have to take care that the period that you're looking at. Um, but in my view, the better way to do this is through my system called deposit offer. So deposit offer. See, when you think about it, a lot of fund managers, a lot of people, who run management, they bought a lot of shares, including banks. They put a lot of shares. Sometimes they put the shares as collateral. You mean so they can borrow more and more money. So the banks have this problem. They have a lot of shares, and they're worried that the market is going to crash one day. But the thing is that the banks, the banks doesn't have to worry that much, because if the market do crash, they just have to sell it. Whatever price they will sell it. So the ultimate problem will come back to the lender, the person who loaned the shares as collateral. Because if the shares goes to zero, then he has to pay the amount that he borrowed using the collateral of the shares. Normally, the banks will lend you up to, I think, 50 or 60% of the value of the shares. So, for example, if you bought a $300 shares, they give you an extra collateral up to 50 or 60% of the 300. So it's not really much, but to some people, that is sufficient enough. So what does deposit offer do? Deposit offer allows people who have deposits, who have cash, to deposit the cash of the bank and get a higher interest rate. And the way they can get a higher interest rate is for them to actually tell the bank that they are willing to buy certain shares. For example, Alibaba or IBM or whatever, at a certain price at their own choosing. That means they decide this is the price I want to buy, and if there's anybody who wants to sell to the deposit holder that price, then they will have to pay him a premium. It's just like it's the reverse of the put option. So we are looking at a situation where instead of going to the exchange, right, where the sellers are probably institution, you have retailers. You have retailers here who are willing to buy certain shares. Say, for example, IBM, or I'm using the word IBM. I'm not advocating that. Uh, I'm just saying as an example, IBM or Apple or whatever at a certain price they want. You see, the beauty of this system is that you are looking at retailers, people who probably have a lot of cash, and they probably have a stock account as well. But if you have been in the stock market, it's very very hard to chase what they call the market when it's going up. So people who have all the money in cash prefer to buy when the market comes down. But you don't know when the market will come down, right? You can't just put the cash in the deposit waiting for the day. So you need to do something. So with negative interest rates coming up, the best way for the banks to do is to actually help these people by asking them what kind of shares do you want to buy. I mean, if you want. The banks do have customers. For example, the portfolio manager people who have borrowed money from the bank. As I said, the bank doesn't care. The bank can just sell all the shares. If it drops below a certain value, they just sell. They don't even give you a call. They just sell it. They have to protect their own interest. So for these people, customers of the bank, so the bank now sits in between. So the customers of the banks who have loaned money, so borrow money from the bank and use the shares as collateral, they can actually go to the stock exchange, like I was saying, to buy insurance in the put option, right? Or they can ultimately come to my system where they can find depositors who are willing to buy certain shares at a certain price and then pay them a premium, just like the way they pay the stock market, the options market a premium to buy whatever insurance they need to hedge their portfolio. The reason why I'm advocating this is because this is an alternative to the options market. This is a retail market where people do not if you have no understanding of options at all, just like me, if you explain what the option is, you just have to explain to this person who putting money in your bank telling them that, hey, you put all your money in cash. The interest rate, for example, in Australia, the interest rate is 0.01, right? It's lucky they don't charge you. Some banks do charge you for transaction, but most banks don't. But it will come a time when it's really not worth it. So what you can do is that you can say, hey, I want to buy BHP shares. Now it's doing at 36. I want to buy at $30. That's $6 from the current price. Maybe there's a premium for that kind of insurance. I mean, for that kind of put option. Maybe there's not. It depends. But like I say, the reason why I choose a retail market is because the retail market is very flexible. The retail market is very flexible because everybody sees the stock market in a different way. Everybody sees the stock market and the stock price in a different way. There's what we call the price that you see in the stock market now. It's a balance between buyer and sellers at an instant of time. So at an instant of time, that is what they're doing, right? This is the price they want. But in the long run, in the long run, the price could be different. The price could be different. Let me find you one. So, for example, in this case, this guy has $50,000 US, and they are using a current Goldman Sachs as their current financial institution, right? So what they want is that they want a swap deposit for Amazon, and they want to swap at this price at 1,500. I think Amazon is doing about, it's more than that now. It's much more than that. So they make it very clear that they want this, and if somebody wants to hedge Amazon at $1,500, they can reply back to them and say, this is what I want. And you can actually build this into the bidding price. Let's say, for example, in our case, is the USD, is the actual amount of interest. Say, for example, if we want to give this person 3,000, I think it's a bit more. So it's about 8% return per annum. So it calculates for you. Um, so 8% currently is 1%. So that will probably include the premium here. But like I said, for most people, for retailers, the aim is really to get a higher interest rate. They, if they can buy the Amazon shares at 1,500, it's better for both parties. Uh, for example, I mean, like, we are just trying to match the scraps. I mean, we're just trying to arbitrage in a way. So the more depositors, I mean, for example, if this is only one depositor and have $50,000 and 1,500 shares, it's probably not a lot. But at 1,500 price, how much it would get? Just let me calculate. Just a minute. All right, sorry for the delay. $1,500, which is not true. I mean, which is way from Amazon. With $50,000, you can only buy uh, 33 shares, so there's not much. Just to make some comparison, the deposit time is actually about 9 months. So December 15 to September 11, so it's about 9 months. All right, so let's go to our options market and see what the equivalent will be for a 9 months option. All right, welcome back again. I'm just looking at the Amazon options market. Closing price yesterday was 3117, right? So remember we had the problem of 9 months. We need 9 months to protect our Amazon shares. So we want to calculate how much the option price would be according to the financial institutions. So 9 months to be 270 days. So let's look at 150. 1,500. I don't think there's a price. 1,500. 1,500 is about $8, 11.80. 8 11.80. I'll just take the middle price, right? I'll just take the middle price. Normally, you would not be able to do that, but you just take the middle price. Right. The middle price is about $9.80. Okay. But remember, the $9.80 is for 100 shares, right? As I was saying to you before, for the depositor, he's only looking to buy 33 shares. So actually it's $9.87 divided by 100, okay, times 33. So he will actually only get $3.25. $3.25. So in this case, it will be cheaper. It will be cheaper for the institution to to come to buy from the financial, because I think, to buy from the exchange than to pay him. Uh, pay him $3,000 and give him 8% return. I'm just basing it on, let's say, 3,000 divided by 50,000. It's 0.06%. No, 3,000 divided by 50,000. It's 8%. I know why, because it's based on 9 months. The 8% is per year, so actually he's getting about 6% for the 9 months. So anyway, perhaps in this case, let's say for example we put $3, right? It's 0.01. It's not really worth his time. I guess it really depends. If there is, like what I was saying to people is that every time we look at the stock market, the stock price is what people perceive the stock price is. Is what we call the personal stock price level. So some of us see a stock price to have certain value. Just imagine, just consider this point. Five different analysts look at the same accounts will come up with a different price, expected for the stock. So it's the same with the retailers. So if the retailers wants to buy, it's up to the institution. In this case, the portfolio managers, they can decide that they can buy from the options market, or they can come here as alternative to use this system to entice the depositor to bank with them. There could be a lot of benefit that comes through this. For example, like you divert interest. Sorry, you divert deposits from another bank to your bank, and so on and so forth. So competitionally, there is a case where you offer a competitive bid for your customers. Right now, banks doesn't do that. Banks are not a creature of competition. I wouldn't go as far as saying that, like what Jack Ma say about the banks, that they are just a pawn. Anyway, that doesn't matter. But what I'm saying is that for banks, they need to be competitive. One way to be competitive is that you can give people a better uh, return on their money, and at the same time becomes an intermediary for portfolio managers to hedge their portfolio shares instead of just going to the the stock option exchange, right? So of course I'm the inventor of this idea where you can ask or swap your deposits with other things, for example, shares, gold bar, whatever. I mean, I'm just suggesting at this time using shares, but it can be bitcoins, it can be anything. What I'm trying to say is that I'm trying to build a different platform where, first of all, we make sure that the market is competitive. The banks must be competitive, and secondly, alternative to the options market, particularly the put options market. Okay, thank you very much for listening. I hope it has been easy to understand. I invented this way back 20 years ago, and until today, man, banks still don't see what I'm doing. I think the problem with banks, because I used to be a banker, and this thing that I just showed you was very profitable for private, I mean for private clients. See, private clients have a lot of money. They have a lot of money. They just don't know what to do with the money, and they can either use the money and park it with a fund, sorry, a portfolio manager, a fund manager to buy shares, or they can just park it with a bank and wait for the price to come down. At the same time, they can actually offer the deposit as a hedging instrument for all these portfolio managers. Imagine today, so many of them, they are not hedged at all. Some of them, they're not even, they don't even understand what the hedging mechanism is. I can tell you, I mean, even airlines used to hedge oil. I mean, the fuel price, because when it went up and it goes down, they hedge it, but they do it on and off, so it becomes problematic. But more all portfolio have to have some kind of hedge, either a stop loss, and it's very dangerous for portfolios, big one, because if we have a stop loss, it will just it will just carry on. The price will keep on falling because you have so many shares to sell. You're not, it's not like us. We've got 100 or 200 shares, 300 shares. They got so many shares to sell when the market goes. So for them, it's better. The only option they have is to buy an option. Now they can buy from the options market, or they can use this new platform. That's my idea. Thank you.